Hi everyone, welcome to Finance with Justus. I'm Justus. Medical Properties has been falling from around $20 in 2020 to now $5. And the dividend, despite a dividend cut, is still sitting very high at 11% now. I'm an investor in Medical Properties Trust. I think the stock is greatly undervalued right now. The fundamentals are still strong and they still support the amount of debt the company has. Of course, the main concerns for Medical Properties Trust are the debt load and the tenants. We're first gonna go to the debt. They have around 9.9 billion of net debt right now. With company debt, two things matters. When does it mature and is it variable or fixed? 14% of Medical Properties debt is variable rate and they pay currently around 6 to 7% on this. And here most of the debt matures in 2025 to 2027. So for the next 2 years, the debt levels will not be that high. They will only have around 500 million per year maturing. And they themselves said for the loan that matures in 2023, they can just write a check and pay it off. So they have no liquidity crisis right now and probably for the next year. But in 2025, they will probably have to refinance some debt. Unless they sell a huge amount of assets, which is unlikely they will do. Now, why does this matter? Rates by 2025 will probably be lower than today, even though most hawkish people agree that rates will not be the same as now in 2025. So these low rates they have, they will stay for a bit. They will not be rolled over that quickly, and some loans will even be paid off. So this 3.9% they currently pay on their debt, it will probably go up, but not very soon, and also not that much in total. But they can afford if this goes up. Per quarter they have around 104 million of interest expense right now. Even if this doubles, which is unlikely to happen soon, but you want to be very careful with these stocks. Medical Properties is highly leveraged. You want to have a huge margin of safety in there so it doesn't backfire and they could go bankrupt. So even if this doubles to 200 million per quarter, they can easily afford this. If you know a thing or two about REITs, the net loss doesn't matter because that is heavily skewed by depreciation, etc. What matters to you is funds from operations. Their funds from operations was a bit different. They had a write-off in there, but they also had a one-time tax benefit from the UK. But I don't like that they completely say this write-off will never happen again. I will come later to this write-off, but let's say they will write 40 million off per quarter instead. That means they still have 240 million of funds from operations. And now, if you take the doubled interest expense, that would be another 100 million. They still have 140 million of funds from operations per quarter to pay down debt. Because, in fact, they could completely cut out the dividend. They already cut it before. I would like it if I cut it off. So the debt in this and next year will not be an issue. And even afterwards, they will have managed their balance sheet. They will have accumulated more cash or already have paid down debt. So I would say the company will not go bankrupt from its debt. So we can look to the next big thing. While they are widely diversified where they have their assets, they have a lot of big tenants. That is the issue. Because the 2023 numbers are a bit skewed, I would say we look at the 2022 numbers for now. They have 3 big tenants: Prospect, Circle, and Stewart. And of those, Prospect and Stewart are kind of struggling right now. In fact, the $95 million write-off ad was with Stewart. So this is where you have to look as a Medical Properties shareholder. The debt situation is manageable, but if the tenants fail, then the funds from operations is challenged, and that is where the issues arise. They are working to reduce the risk in some parts. For example, a few hospitals that Stewart was operating were taken over by Common Spirit Health, so they're not the operators there anymore, so that reduces risk. But they also partially have sold off some hospitals that Stewart was operating, where they now have a 50% partnership, but the risk is greatly reduced now. But Stewart is slowly coming back. Their fundamentals are improving. You need to watch out for that, but I would say for now, the Stewart risk has been reduced, needs to be reduced further, but the situation is greatly improved. Now to the other struggling tenant, Prospect. They are also having some fundamental issues right now. Medical Properties is doing something here which I do not completely like. They are investing in their tenants. They invested some money into Stewart to help them get back up. And they also invested some money into PHP, which is Prospect. Here, in fact, they got a very huge chunk of the business. It was put on hold sometime by California regulators, but that is normal. It should probably go through. While it may have helped the tenants and may have been beneficial in the long term, it also increases the risk. Not only do you have a lot of revenue coming from them, you also have money invested in them now. So while Prospect was struggling, they got a huge stake in them now. Maybe it will work out in the end. It is something I do not like. This is my biggest issue with Medical Properties. But they said they will scale that back. But currently the fundamentals of all tenants are bettering. Prospect and Stewart, which are the main issues, are improving. And as long as that continues, I don't think this will become much of an issue, but they should probably diversify away from that. They are currently still selling off some hospitals. They're selling, for example, all the Australian hospitals. That will provide more cash to pay down debt. So now comes the numbers game. Where do we think Medical Properties Trust is a good investment? This is a more riskier stock. We should have a huge margin of safety, just like with a debt. I said before that normalized, I would probably put this as 240 million funds from operation. But let's be more safe, and for whatever reason, they will only have 200 million. Plus, more interest, and it will be 150. So that would be around 25 cents per quarter. On the year, that would be $1. So if we say they have funds from operation of $1 per share, and a growth rate for the next 5 years of 5%, and the next 5 years after that of 4%, which would be very conservative because it would start very, very low, and we expect very, very low growth, but this is what you need to do for these stocks. I put a payout ratio of 50%, plus a discount because of immediate tax, at a required return of 10%, that would bring me to an intrinsic value of 12.11. The current value is 5.5. So that is a 120% discount. This is why I like Medical Properties so much. As long as the tenant situation doesn't worsen, I think the company will make you a lot of money. I don't think it will go back to where it was in 2022, but I think you will make a great return at these buying prices. What do you think? Write it down in the comments. Have a good day.